It's the options for me.
Foxtail from the D.
Hey, what's up YouTube? This is Foxtail Digital coming to you again with Black Girl Stocks, and in this video we are going to be talking about options. So this is the video that you guys have literally been waiting for, like for real, like you telling me you're waiting for it, and then you putting like these little side eye emojis and stuff. This is how to start trading options, okay? So I'm actually going to do this video in two different parts. And in the first part, I just want to get a basic understanding of what options are and how you can get started with doing them. And then in the second part, I really want to physically show you how to get started on your phone. So this we can do on our phone. I love to do it on the phone. That sounds weird. And just go over what you're gonna see and what to look out for. This is the basics of options trading. But first, if this is your first time watching this video, please make sure you click that thumbs up button. It really helps the channel. Go ahead, click the thumbs up button. Also, make sure that you subscribe and click that notification bell so that you get notified anytime I upload a new video for you guys. So, option trading may seem a little bit overwhelming at first, but it's easy to understand if you know a few key points. So we are gonna go over definitions, key facts, tips, tricks, flips, all that stuff, really to get you beginning, because I promise you, it's the options for me. I mean, you can get an option and you'll just see so much return so fast versus just buying the stock. Literally, when you buy a stock, if it goes up $1, then you get $1. Great. But with options, if the stock price goes up $1, you stand to gain a lot more. I mean, it's percentages on that. Percentages, and just it's a really nice return. So let's get started. Part one, what are options? Okay, so what is an option? An option is a contract that gives you the right, but not the obligation, to buy or sell any stock that we're talking about. So to buy or sell a stock at a specific price.
Strike price. It's the strike price.
Right, the strike price. So you threw me off. So it gives you the right but not the obligation to buy or sell 100 shares of a stock at a strike price on or before a certain date.
Expiration date. Expiration date.
Right, the expiration date. So you have to buy or sell it on or before the expiration date for a fee.
It's the
Premium. You have to pay a premium every time you buy an option contract. So basically your premium is you paying for this amazing deal that you were gonna get. Because I'm telling you, buying options is so amazing. Although options are amazing, there are risks that come with options. So I really just want to put this out there first, but there's a warning that they put in. Options involve risk and are not suitable for everyone. Options trading can be speculative in nature and carry substantial risk of loss. Let's go. Before I give you any definitions, I just want to give you a little example of why buying options or buying option contracts versus just outright buying stock shares is so lucrative. Let's just use this as an example. Let's say you have $300 to invest in stock XYZ, and then assume that stock XYZ is trading for $100 per share, and you're betting bullish over a short term, basically meaning that you feel like the stock is going to increase in price in a short amount of time. Let's say 30 days. So in 30 days, you feel like the stock is going to go up, okay? And you have enough money to buy 3 shares, because it's going for $100 per share and you have $300. So you're just throwing it all in there, honey. You don't care about, I don't care if I lose it all. Sometimes you gotta go balls deep. Sometimes you gotta go all in. But on the flip side, so that's how much we can put as far as actually buying the shares. But then on the flip side, let's go over here to the options portion of it. And let's say that, there's one option contract with a expiration date that's a month away. So it's a 1 month expiration or 30-day expiration. And it's a option contract with a strike price of $110 and the premium costs $3 per share. Okay, so your premium is $3. And buying one option contract is gonna also, so buying one of these option contract calls, why am I saying contract? We're buying a call. So betting it going up, that's the option call. So this is an example of an option contract call, an option call. So buying one XYZ contract is gonna cost $300 because the premium price is $3 per share for getting this deal, but that's over 100 shares at the strike price of $110. So that's gonna cost you $300. Actually buying 3 shares of the entire underlying stock for $300, or you can buy one option contract for $300. That's betting that the stock is gonna go up in a month, which it probably is because we're gonna pick a good stock, like you already know. So let's fast forward 30 days. So before this contract actually expired, because we never wanna wait for the option to expire. You don't wanna do that unless you're writing the option or selling it. And that's a whole other thing. We're gonna talk about writing options or they call it writing or selling, because you can buy or sell. So right now we're just talking about buying option. But before this option actually expires, that stock price jumped to $150 per share. And so now the premium for that same contract that you have is worth $8. So it jumped from $3 to $8 per share. But you only paid $3 per share. So times 100. You see where we're going here, right? XYZ is now $100 per share. And so let's go with the option of you buying the 3 shares and the stock price increased to $150 per share. So theoretically, if that stock price jumped up to $150 per share, that means there's a $50 profit per share that you purchased. You purchased 3. So that's total of $150 profit, okay? Or basically a 50% return. I mean, it's okay. So for $300, you get $150 back. That's cool, great. But now let's go to the other side, and let's say we actually bought an option contract instead of just buying the stock shares. Instead of that 3, we're gonna buy one contract that gives us power over 100, okay? And so the purchase of that $150 call option contract, with that, you're gonna have a profit of $800, okay? Because now that premium is $8, so you're gonna multiply that 8 times the one contract that you have times the 100 shares. And so that's basically $800 profit. But then you do have to pay for that premium, so they're gonna take that out. And so you just subtract that 300, but that still gives you a profit of $500. For that same $300 that you put in, you got back $500. That's basically a 266.7% increase. For the same amount of money that you put into that option, you got so much more money, like a lot more money. So that's basically the glamorous part of buying options, is that huge leverage. That percent increase is insane versus that little dinky, $150, honey. No. If you really want to start flipping some coin, options are where it is. But like I said, vice versa, the same thing can happen if you were wrong. But when you're actually just buying calls and puts, the only thing that you stand to lose is your premium, or that premium price, like in this example, that $3, or the price that you pay per share to have this amazing contract, because when you have contracts, sometimes you have to pay for this good deal that we're getting. Like, it's kind of like buy one, get one half off. Like, it's not half off up front. You're gonna have to put a little cute piece up before you get into the club. And so that's what the premium is. But that's what that is. But let's go ahead and let's get into some definitions and stuff. I know I'm throwing all these strike prices and words around, and you're probably like, what is that? Let's just get into some key definitions, okay? So first, with options, there's 2 different types of options that you can get. So there's a call and then there's a put. And so basically a call option is you feeling that the stock is going to increase in price. You want to put a call option in. And on the opposite side, a put is you feeling that the stock is going to go down. So you feel like it's going to go down, so you'll get paid and you'll make profit when the stock actually goes down. A completely different reason why options are really lucrative because anytime you're buying stocks, actual stock, honey, if the stock is going down, honey, my profits are going down. I'm not making it. But with options, you have different options to have strategies to make money even when the stock price is going down. It's absolutely insane and so lucrative. That's why everybody loves options. That's probably why y'all have been begging for these videos, honey. We're about to start getting into our options because honestly, a lot of my profits come from options. It's easy money. You know, you have to be careful with them too because it can mess your account up, honey. You can wipe it out, honey, like wipe out. Okay, so for the call, just think about when you're at an auction and people are calling out their price that they want to bid for something they want. So they're calling for it. Yeah, storage wars. Yeah, and all that bidding and stuff. So that's a call. Yeah. So when you're wanting to call, you're calling for that strike price. So that's that price you want to get. This honestly, it sounds like a whole little auction. All this options and stuff is just like the auction, honey. I feel like I'm in storage wars right now. But then think about puts like this. So when you're buying a put, think about it as if you have the privilege to put this item on sale. Okay, so I can put it on sale because I have that privilege, I have that right, I own it. It's a form of ownership. But keep in mind, when you're actually buying a call or put, then you do not have an obligation to buy or sell that stock. You don't have to. But on the opposite side, when you're selling a call or put, you are obligated to give that buyer all that 100 shares if they actually wanted to exercise it. But I mean, unless you just have that money, like let's say if the strike price is what do we have here, $110. As far as selling calls and puts, unless you have that $11,000 to, you know, buy the shares at that price so you can sell them to that buyer, then that's on you. But I don't have $11,000 in my account, and I don't, yeah. So most times, a lot of times, especially for beginners, if your portfolio isn't, you know, big boss like that, then you can buy and sell these contracts before the expiration date and you can gain that profit, you know, just minus the premium price. So, I mean, that's that. So calls and puts that you can buy and sell. But right now we just want to focus on buying because the only thing that you stand to lose when you're buying calls and puts are your premium. But on the opposite, if you're selling, like I said, that means that you're obligated to buy all those shares if that person, you know, wants to actually exercise that contract. But, you know, if the stock still is going down and it expires worthless, then you gain however much it went down. I mean, I'm not going to talk about selling because I don't really do that myself. It's very risky and I wouldn't advise any beginners to do that because you can really get yourself into some mess that you don't want to be in. So just focus on buying calls and puts right now. That's where it's a little bit safe. The waters are it's a little shaky over there too, but it's not as bad as over there with the selling. Child, they'll mess you up. What is the strike price? Strike price is the value that you see the stock having at or before the time of the expiration date. So you expect the stock to go up to that price, the strike price. So just think about it as it's going up to that strike price. And when it strikes, we win. Wow, that is nice. I never thought about it like that. See, you helping me out. Helping you is helping me too. Me too. Anyways, the strike price is the price that you bet the stock going to by this expiration date. It's so easy now. And then the premium, that's just like, you think of premium prime ribs. This is premium, honey. You're gonna have to pay to get into this club because this is a lot of money. You saw that difference between that $150 versus this $800 or $500 after you pay the premium. But it's a huge profit margin. It's really cute. So yeah, that's the strike price. And then the expiration date is, like I said, that date that contract cannot go past. So the farther the strike price is from the actual price when you buy the option, then it's usually gonna have a lower premium if it's farther away. That means you're gonna be out of the money. Oh, should I get into that? Different stocks have different expiration dates. A lot of the larger stocks like Tesla, Apple, you know, things like that, they have more frequent expirations. So they may have weekly weeklies, monthlies, yearlies, and stuff like that, because you know they have faster rewards, and the things going up and down, honey. It's huge, and there's so much volume. But then on the other side, they have other stocks that just have maybe weeklies, or some only have monthlies. So, but don't let it expire worthless. The only time you ever want it to expire worthless is if you're selling calls and puts. But we're not talking about that. Like I said, we're only talking about buying them, okay? And when you're buying it, you do not want to expire, because that basically means you just threw your premium away. And no, we don't have money to throw away. Hey! So I think you have a pretty basic understanding of what options are. You know that there's two types, calls and puts. Calls going up, puts going down. I'm going down. That's a put. I think you guys are ready for the second part of the video, and so that's actually going to be jumping into Robinhood, honey, so we can see what, you know, these options are talking about. The stock that I'm going to use is NIO, and so NIO, it's a company in China. It engages in the design, manufacture, and sale of electronic vehicles. So essentially, it's a competitor of Tesla. This is nice. The company provides users with home charging and power express valet service. What? I like NIO, whoever. And so basically what you're gonna do is you're gonna click on this trade, and this is gonna flip up, press trade options. And so here, this is a pretty, you know, basic rundown of what all can happen to the stock. Do you think it's gonna go up? Do you think it's gonna go down? Do you think it could go up or down? You don't know. Or do you think it's pretty much gonna stay the same? Because you know there's some stock that they just don't move. It's just looking just real grandma. Just I think that obviously we see on the 5-year trend, you know, 5-year trend, think trend, always find trend. And we all, you know, you want to find your majority of the trend on the 5-year marks or the year mark. You know, you want to start from far away and look up here. You see up here at the top, all of these different dates. These are different expiration dates. So they have expiration dates, you know, a couple of days away, September 25th, because this is the 17th. They have one October 2nd, all the way up till January 20th of 2023. So that is a long time away. Of course it's gonna go up. So let's get into it. I'm gonna press on October 2nd. And so once you select your expiration date, you see this list right here, okay? So you see this list and you see, I mean, it can go forever, honestly. Not forever, but I guess they have a little stop. But okay, so you see this right here, the share price in the middle. So that is what the market price is right now. That's how much this stock is per share right now, $19.30. And it really went up because I actually have a contract, and I mean, it's making me some coins, so I'm appreciating it. Thank you so much. Keep going up, honey, because Tesla, she wasn't doing nothing today. She wasn't talking about much at all. So a few things, you see this right here, this 19, let's just do the one right underneath it, because this one is gonna be very profitable. Well, it's gonna be profitable for a lower price. So this right here that you see where it says $19 call, that is the strike price. So this price right here, this is the price that you see the stock having that value at the time it expires. So by October the 2nd, I believe that this stock is going to be $19 and up, because I'm buying a call. I'm expecting it to go up. But the further this strike price is away from the actual share price, the more profit that you stand to get. That's why they cost more money, because I mean, obviously if the stock is $19 right now, but I have a $17 call, I mean, I'm just gonna get a lot more money. So that's why it's more expensive. This right here, this is the strike price, and you see this right underneath it, it says break even at $20.75. So once the stock gets to $20.75, essentially you would have broken even. So that price that we pay, the premium price, that profit will, so that basically means that you've made your premium back. So we broke even. And so to break even, that would mean that the stock would need to increase by 7.40%. And this over here to your right, the far right, in the little box, that is your premium price per share though. So to buy this contract per share, you would have to pay $1.75. So you're going to, that's per share, and one contract gives you the right to buy or sell 100 shares. So just multiply that $1.75 by 100 if you want one contract, and it'll cost you $175. Or if you wanted 5 contracts, it would be $875. But we would just say one. Okay, so that's just basically that. And then on the flip, you can click up here and that's gonna sell it. Oh, no, we don't wanna do that yet. Hold on. You wanna make sure you're on buy, okay? And then I really wanna make sure you guys, please make sure when you're buying options or doing anything with options, make sure you have the right expiration date, because I literally just did that yesterday. I bought it at a terrible strike price. You really just have to pay attention because you can mess yourself up. So just make sure you buy it at the right strike price, because the strike price I did yesterday was way too high, honey. In a month away, I said, girl, that stock isn't going up that much. So I made sure I sold that today. Okay, so we're on the call. Then you click over here to the put, and then you see how it changed colors. That basically means the color change. The ones that are green means that portion or that call, like the call option, those were in the green. Those made profit at this time, at the end of the day, because the stock market is closed right now. Like, I just got off work. But then if you click put, you see it's red. Well, I mean, NIO is going up. It's really going up. And so that's why the put side, they're red, because they're mad. They didn't do anything today. You can click over here to selling it. But we don't want to look at that. The prices are about the same too. Okay. So, I mean, that's what's up. Buying or selling, the prices seem to be about the same, but it's just, you gotta make sure you're right. It tells you the chance of profit, 71%. What's up? Let's go ahead and let's just click on the $19 call. And then this screen is gonna pop up right here. And I really wanna say this right now, the overall value of your option contract, it's not based solely on the actual stock price. So that's just one factor of what goes into option value. So for example, let's say the stock price goes up. Okay, let's say it expires tomorrow. So you waited a little bit for the expiration date and the stock price goes up a couple of dollars. And you would expect, a lot more profit, but your option value only goes up a little bit. That's because there's more than just the stock price that goes into option value. There's actually 6 things. The strike price, the actual price of the stock, the dividend yield, the prime interest rate, how far or how near you are to the expiration date or time decay. So the closer you are, the less value it actually has. Because just imagine, if you were a person and you actually had the money to buy that 100 shares, do you want to wait until the same day that the option contract expires? I'm not gonna have the time to do my flip. Like I want to relax. I mean, if I'm sitting here with $17,000, I'm sitting probably on the beach somewhere. I might not get to it until tomorrow. So no, I need more time. So that's why the more time you have, the more valuable the contract is. Okay. And then the last thing is the volatility of the stock. So because all of these different things make up the price, it's really possible for the price of the stock to go up, but to actually have your option contract price go down, or the value. And that's definitely happened to me before. The first time that I bought an option, I was so confused because I bought a call and I thought that I was just gonna hold on to it. The longer I held on to it, the more money I was gonna get. But no, the longer I held on to it, the less money I was getting. And then it would start to drop because it was losing value. And I was just so upset. And I was like, what the is this? I don't like this mess. But you can't be afraid. You have to, if you fall off that horse, you have to get back on it, child. Don't worry about it. So you see here, each contract gives you the value of 100 shares. And then right here, you're gonna click, and this is essential other things that go into the value. Like here's the implied volatility and then the Greeks. Okay, so first, before you even buy an option, make sure that you check out the volume and the open interest. So volume, that's basically so volume versus open interest, they're two different things. Volume refers to the number of contracts traded during a given period, and open interest is the number of contracts that are active. So the number of contracts that are actually going on. So open interest, as long as there's somebody that has it, that's a pretty good sign. And then the volume, it just kind of seems like the volume, how thick it is, how filled up it is. Is it good? How much is going on over a given time period? So you want to make sure that you have a good volume, a good high. The higher the volume and the open interest, the better that this move is going to be, because that means there's a lot of people going in and out. There's a lot of people that are willing willing to buy and sell. If nobody's willing to buy or sell, this isn't gonna work, because this is actual contracts between you and other people. Like, this isn't between you and a computer. No, if there's somebody on the other end of that screen that's saying, I hope that I hope you're wrong because I'm taking your money, you know, this is what it is. You know, it's kind of like, it's pretty innovative. It's really nice. And so the Greeks down here, I'm not going to go into the Greeks right now, but the Greeks really have a lot to do with the value of the option. So like, I know a higher delta is better for you. The lower the delta, the less good you're going to be doing with the option. Let me see, implied volatility. And so implied volatility is the market forecast of movement in a security's price, because we always say volatility is really, really good. You want a lot of volume and a lot of volatility, because when the price goes up and down, that is, you know, that's basically possible profit point for both sides, up, down, up, down. So implied volatility means that it's gonna move, and that's what we want, unless we don't want the stock to move. Like if you chose the one where we're just going, you would want to lower implied volatility for that. When we want it to go up and down, or up or down, whatever, implied volatility is important. So yeah, another thing I want to talk about is at the money, in the money, and out of the money. So let's go back here. And so let's look, we have it here. So a call option is in the money when the actual price of the stock, like the market price of the stock, is higher than the strike price. So for a call, all of these above this price, those are in the money. So yeah, you see how we have the share price and we have 19. So all of these strike prices underneath the share price, those are all in the money. And that's why the further you go down, the more they're gonna cost, because they have more value. They're more in the money. You know that you're gonna make profit, because we make profit however high up above the strike price is. So you multiply that by 100. Like let's say if we had this, let's say if we bought it, like, yeah, you remember from the other example, when we started off at $1 and then or $3 and it jumped up to the 8, you saw how much that was. So the further you go down, the more money we get. Just like on ours, we started from here to 3, and let's go all the way up here. Yeah, that's a big difference. Sheesh. So that's in the money. And if it's out of the money, that just means that it's not currently there. We have to wait for a little bit to see what happens. Like all of these above it, it's not at 20 or 21, 22. It has to get there. So that's kind of a gamble. So that's why it's called out of the money, because we're not for sure making profit yet. We have to see what happens over time. And then at the money is when the strike price is the same as the share price. So that's kind of like the break even. We're at the money. So we're not losing, we're not gaining, we're just at the money. I just want to make sure I show you how that you can make sure your account is set up to do options. So you're just gonna make sure you click up there, top right, and go to, yeah, you have to go to investing, and then you just have to turn on option trading. That's how you get to it. The same place you get to your day trades and stuff like that. I mean, that's pretty much it for the options. I'm gonna be doing more videos down the line about options and strategies and actually showing you in real time. But I think for now, I just wanted you to have a really good understanding of what options are, how you can get into it, and why are they better than buying just outright shares of stock. I don't wanna say better, but they're definitely, they give you more opportunity to make money, more money from your investment. So if you want to make more money fast, options are the way to go. But you really want to be knowledgeable and know what you want to know what you're doing, what you're getting yourself into. So that's pretty much it. That's all I have for this video. Tell me, are you interested? Are you trading options right now? Leave a comment below and tell me what you think about options, and if you feel like you're ready to start trading options. I'm interested to know. So let me know in the comments below. Just please make sure that you click that thumbs up button if you found any type of value from this video. Click the thumbs up button and make sure that you subscribe. Click that notification bell so you get notified anytime I upload a new video for you guys. And yeah, I'll see you on the next video. I appreciate you guys so much. All right,